Hello and welcome to AJ Bell's annual results presentation for the year ended 30th of September 2020. We were pleased to announce our results this morning, and here to talk you through them in more detail are CEO Andy Bell and CFO Michael Summersgill. A full copy of the slide presentation will be available on our website, and we hope you find today's presentation useful.
It's been a good, strong year of organic growth. We've had total customers up 27% to just shy of 300,000, with total AUA up by 8% up to just over 56 billion. That in a period when the all-share index fell by around 19%. That's led to record financial performance, both in revenue and profit, both ahead of consensus. And really the story of the year, as we all know, has been COVID-19. We've adapted to working from home conditions very quickly, almost without missing a beat. All our services have remained intact all the way through, both on the advised and the D2C platform side. We've not taken any government support. None of our staff have been furloughed, and as some of you will have read about, we had a wage war on COVID campaign earlier in the year where a number of senior staff, including myself, waived 3 months of our salary. A large number of other staff joined us. For the £380,000 that's been raised so far, we've already donated £280,000 good causes and have committed to spending the rest of it in the coming months. And a final comment on this slide is that we increased the ordinary dividend, a final of 4.66p, which is a total of 6.16p following the 1.5p at the half year. So that's a total dividend up 28% in the year. So turning the pages, on page 5, we've got the equity story, which you'll all be familiar with. The only point I would say there is that it's exactly the same equity story as we came to market with. There's been no changes to that. Moving on to slide 6, just picking off a few of the relevant issues. In our market, I think we estimate the market to be worth at least 2.5 trillion. I think that is a significant understatement. I think that if you add in the DB money that's relevant to our market, you're probably putting another 2 trillion on top of that. The structural growth drivers that have always been prevalent in our market, which are covered on the next slide, they continue to drive the business forward. And probably the one positive legacy of COVID-19 has been the fact that people are engaging with the finances an awful lot more than they have done in the past, and therefore taking greater responsibility for the financial future. If we look at our proposition, what we've seen again in what are quite strange times, we've managed to continue developing the propositions. On Invest Centre, we've seen the introduction of the RIA and third-party MPS. On AJ Invest, we've seen the Cash Savings Hub and a new investment trust select list as well be introduced. If you then look at the customers we're attracting, our growth continues to be organic across both platform propositions, and we've seen really impressive growth on AJ Invest, with a slight change in the demographic of the type of customer we're attracting, which I'll cover later. So moving on to our business model, COVID-19 has certainly put the robustness and scalability of this to the test. We've seen record new business and record dealing volumes throughout the year, all of which while the vast majority of our staff have been working from home. As many of you will be aware, on 9th of November, the vaccine announcement saw a number of industry-wide issues, mainly focused in the larger, more popular D2C platforms, both in the UK and in the US, but also extending to market makers. Notwithstanding that, we still saw one of our largest ever dealing days on that Monday, but one which undoubtedly there will be lessons to learn both for us and the wider industry. Finally, on this slide, on our people, we've maintained our 3-star accreditation. It's culture that is key in our business, and it's one of my key jobs to maintain that culture of founder-led entrepreneurial business. And just one point that we have commenced formally now the board recruitment process where Les is chair. He's done in excess of his 9 years as chair, and we're looking for a replacement along with two new non-execs to boost the board. Turning on to slide 7, really the graph, all that does is reiterate the point I've made in the past, whereby AJ Bell is growing faster than the platform market. The platform market is growing faster than the UK financial services market, which itself is growing faster, albeit not a difficult bar to hurdle, GDP in the UK. And then at the bottom we see the structural factors which continue in existence. Just turning the focus to regulation, we've now seen the closure of the investment platform market study. Investment pathways has been delayed. That's been a source of some frustration for me. One, I've been lobbying personally with the FCA over a number of months. I had a really good meeting with them just over a month ago, where some of the what I saw as fundamental flaws. We've had a really good conversation, and I'm confident some of them are being ironed out now. And also the capital regime that was due to be introduced or in new form next year, that's now going to be delayed until 2022. Just look at the current market dynamics. Rather perversely, in a pandemic, we've not only seen the UK household saving ratio increase to unprecedented levels, but also credit card debt repayment at the highest levels seen in a long time. The good side of that is individuals are taking more personal responsibility for the financial future, and this is showing through both in the advised and the D2C market. Paper is something we've all learned that it doesn't work well when staff are working from home, and whilst in the D2C market it's predominantly online. Any paper in the advised part of our business, we've had a real focus on getting rid of that, and we'll continue to do so in the future. We'll touch upon later the guided solutions that we offer are certainly proving to be very attractive to the younger D2C audience. And also, if you look at the market, we called it out the start of the year. There is increased merger and acquisition activity in both the advised and D2C markets. In the advised market, we've seen about 30 billion of assets change hands in the form of Alliance Trust Savings, Zurich and Eccentric. In the D2C market, we've seen about 10 billion change hands, largely in the form of Share Centre and L&G. And then we've seen activity both in the investment space and in the robo space as well. Moving on to slide 8, I think it's no mean achievement to carry on delivering improvements to the propositions when staff are working from home. It has introduced new challenges. I think the highlights for AJ Bell Invest Centre are the introduction of the RIA and third-party MPS, and on AJ Bell U Invest, it's the launch of the Cash Savings Hub just a few months ago. On the investment side, our first 5 funds that we launched came through earlier this year, the 3-year anniversary, and every one of those funds was in the top quartile for investment performance. And more recently, we've launched our Responsible Growth Fund, really aimed at the younger audience and those who are looking for investing with strong ESG credentials. Turning to slide 9, it's probably worth looking at this data side by side to really compare and contrast Invest Centre with U Invest. You see the average age of a customer on Invest Centre is 56 compared to 43 on U Invest. Slight drop, which we'll touch upon in a slide or two on the U Invest side. The big difference is clearly the average assets under administration, 333,000 on Invest Centre, £78,000 on U Invest. Clearly the markets have fallen during that period, so any drop is no great surprise on U Invest. I think the transition to the slightly younger audience is probably explaining away some of the decrease in average AUA that we're seeing there. And then the only other point I would make really on that slide is to reiterate the very high retention rate in both platform propositions. If we're moving on to slide 10, some new data that we've talked about in the past, but we've not shown. So if you look at the first column, so figures 4 and figures 5, I think what we see there is just the scale of growth on the D2C side, all organic apart from the small amount in 2018. And then really something we've talked about almost every presentation now is a shift from what we call confident control over to hungry for help and nervous newcomers. And over the 5 years, you see quite a marked change over that period. Then look at the average age, which I alluded to earlier. The average age for a new customer in FY20 was 39 compared to age 43 over all customers. And we're also seeing a transition towards mobile, and that transition is most prominent in the new customers who are coming through. And then if we look at the final column, figures 8 and figures 9, figure 8 is the responsible growth fund that we've just launched. Over 50% of the customers who bought that fund are customers who've joined us since 1st of October 2019. And then figure 9 just shows the importance that our own investment propositions are playing in the investment portfolios of the hungry for help and nervous newcomer customers. At slide 11, I don't propose to say a lot about. You've seen that information in the Q4 trading update. And then moving on to slide 12, again, just a further dig down into where the new money is coming from on both platform propositions. Something we've talked about in the past, but again, the first time you've seen this data. So we look at AJBL Invest Centre first. We're seeing that in FY20, 25% of the new money is coming from existing customers, whereas 75% is coming from brand new customers who've come in throughout the year. And again, if you look at the average inflows per new customer, really what you're seeing there is evidence of the fact that on the advised side, it's often a consolidation piece that's going on. So the advisor is pulling together often pensions, consolidating them on a platform, and then the new payments in will tick over going forward, but most of the money is brought in on day one. Quite different picture on AJBL Invest. We're seeing a more equal split between where the money's coming from between existing customers and new customers. And again, actually quite reassuringly, we're seeing on the U Invest side that not only is there a decent chunk of money coming in on day one, what we are seeing is this ongoing almost annuity type income where people are contributing year on year and building up to the averages that you're seeing earlier on in the slide deck of about £78,000 per customer. And with that, I'll hand over to Michael to give an update on the financials.
We've delivered another strong set of financial results in 2020. Revenue was £126.7 million, up 21% compared to our prior year. This increase was a result of strong growth in customer numbers, as well as high levels of customer activity. This high customer activity was particularly evident on our D2C platform, where we've seen a record number of trades placed in the year. Our profit margin increased to 38.4%, and I'll talk through the increase in profit margin in more detail later, but at a high level, it's been delivered as a result of the D2C trading I've mentioned earlier, and also the additional economies of scale that we've benefited from as we've continued to grow the business. This all culminated in profits of £48.6 million, a 29% increase compared to our prior year. We're a very well capitalised and highly cash generative business, and that's again been evidenced by our FY20 results. For such a cash generative business, we were probably a little bit conservative with our interim dividend payment, and that was because we were still in the early days of the COVID-19 pandemic. Since that time, the business has continued to trade profitably, and as Andy mentioned earlier, we've not had to access any of the government support schemes that have been made available to businesses. As a result, the board sees no reason to deviate from our previously communicated dividend policy of a 65% payout ratio, and so is recommending a final ordinary dividend of 4.66 pence per share, taking the total ordinary dividend payment to 6.16 pence per share. Slide 15 gives a reasonably detailed analysis of our revenue, so I'll just spend a moment explaining how we've structured the slide. So we've split our revenue here between the three different distribution channels that we see in the business, and then the three different categories of revenue that we have. The three different distribution channels are our advised platform, AJBL Invest Centre, our D2C platform, AgeAbel Invest, and then our non-platform business. The three different categories of revenue that we have are recurring fixed fee revenue, recurring ad valorem revenue, and then the transactional revenue, which is a little more one-off in its nature. One point I would make about the consolidated revenue before talking about the individual distribution channels is that we do have a very high quality of earnings. If we take all of the recurring revenue streams, in total they reach £99 million in FY20, which represents 78% of our consolidated revenue. Focusing on the advised platform, here we see a story of steady increase in the revenue as we've continued to add customers and assets to the platform in the year. The recurring ad valorem revenue category has grown by 11%, and this is the category that contains our core platform charge on the Invest Centre proposition. On the D2C platform, to a certain extent, we see the same story of the recurring ad valorem category being driven forward by the increased growth in customers and assets on the platform. But here, the real story is the increase in transactional revenue, which has more than doubled to 20.9 million as a result of the high level of customer trading activity in the year. And it is this high level of customer activity that has increased our revenue margin from 33.2 bips to 41.4 bips. On the non-platform business, we have seen a slight decline in revenue as previously guided. Moving on to slide 16, here we have our cost analysis. The categories are quite self-explanatory, so stepping through them in turn. With distribution and technology, we have quite a similar story, showing an 11% and 12% increase, principally as a result of the increased headcount in both business areas during the year. With our technology costs, we have also added new tooling to strengthen our processes. So we've integrated Sneak into our change delivery process, and we've strengthened our security capabilities by adopting recorded futures. So we're not standing still on the technology side, but it is really the increase in headcount that is driving the cost increase in the year. The operational and support costs have increased by a higher level than we would have expected at the start of the year. The 15% increase has been caused by a significant increase in the FSCS levy and the higher transactional costs driven by the high level of D2C customer activity. If we were to see consistent year-on-year trading and we had not seen the significant increase in the FSCS levy, the increase in operational and support costs would have been much more in line with previous years at 7%. The exceptional costs are both as previously disclosed. On slide 17, we step through the PBT margin improvement in more detail. Here we can see the profit margin increasing from 35.9% to 38.4%, with the two key items being growth and operational gearing and the increase in our revenue margin. Growth and operational gearing is a category that we see as a source of sustainable profit margin improvement and something that we would expect to repeat in future years. In the current year, we see an increase of 0.9%. However, were it not for the FSCS levy increasing at such a significant rate, that would have been at the same 2% level that we have seen in previous years. The revenue margin improvement, on the other hand, is not something that we see as a sustainable source of PBT margin improvement. In fact, as we'll see when we move on to the guidance slide later on, this is a PBT margin improvement we see reversing in FY21. Now, there's some uncertainty around that. Markets remain volatile, and there's lots of events on the horizon that could see that volatility persist, but sooner or later we would expect to see a reversal of that revenue margin improvement. Moving on to slide 18 and focusing on the balance sheet, there are two key areas to cover. First is our regulatory capital requirement and surplus, and the second is our approach to dividend payments. With the regulatory capital position, we are providing more detail than we have in previous years. There are two main reasons for this, really. First of all, we're wanting to clarify the extent of our regulatory capital surplus, and secondly, there are new capital rules coming into force in the not too distant future, and we want to make sure that investors understand our capital position in detail ahead of that time. Figure 17 provides the detail of our regulatory capital position. The table shows that our regulatory capital requirement has increased by 15% in the year, from 30.8 million to 35.4 million. This increase has been driven by business growth and the heightened customer activity, increasing the potential impact of the operational risks that we assess in our ICAP. Our regulatory capital surplus has increased 38% from 34.1 million to 47.2 million, and that's after allowing for our proposed dividend, and this shows what a well-capitalised business we have. Moving on to figure 18 and focusing on dividends, there is probably little to add to the points I made earlier about the ordinary dividend payment, which is simply in line with our previously communicated dividend policy. However, we have talked about special dividend in the past, and although we are not making any proposals on that front at this point in time, special dividend will be on the board agenda in 2021. The reason that we are not making any firm commitments at this stage is that we would like to see more clarity on the new capital rules before we decide exactly what approach to take with a special dividend. But as you can see from our capital surplus, we are clearly in a position where, should we choose to do so, we could make a special dividend payment in 2021. Slide 20 provides some financial guidance. And if I take a moment to just explain how we've set the slide up first of all. So we've got 3 columns on slide 20. The first column is a restatement of the guidance for FY21 that we provided at the interim. The second column is an update to that FY21 guidance. And in the third column, we're providing some very high level guidance as we look out beyond FY21. Focusing on the updated FY21 guidance first of all, here there is only one item where we feel the need to change the previously communicated guidance, and that is on the revenue margin on the D2C platform. We have increased and broadened the range slightly. So we previously communicated a 30 to 32 bip revenue margin, whereas we are now updating that guidance to 31 bips to 34 bips. There are 2 reasons for this change in the guidance on the D2C platform. The first is the continuation of the high dealing activity that we saw in H2, in particular of FY20, and that has continued in the very early days of FY21. There is some uncertainty around this dealing activity clearly, and that's why we've slightly broadened the range of the guidance that we're providing. The second element of the increase in the revenue margin is the impact of interest income. So in the second half of FY20, LIBOR rates held up better than we'd expected, and where we're locking into 12-month term deposits, that has pushed some of the adverse impacts back into the tail end of FY21. As we look out beyond FY21, the key point to communicate here is that we do see revenue margins falling slightly below their FY21 levels. We're not providing a range this far out, as I believe that's far too specific. But the point we're looking to address here is that there is that slight lag to the impact of the interest rate drop that we saw back in Q1 of this year. So it's not that we see a new risk materialising, just that it takes a while to see the full impact of what happened earlier in the year. The final point on guidance that I would draw out, and this is to finish on one of the big positives I've always seen in our business, which is operational gearing. If we look at the results from FY20 through to the guidance that we're now providing for FY22, then we can see that there is a compression in the PBT margin. But as these slides show, operational gearing is still delivering profit margin improvement for the business. So as we look beyond FY22, the business model is still there to deliver increasing margins once again. And with that, I'll pass back to Andy, who will provide a quick summary of our outlook.
Okay, thanks, Michael. And really just to wrap up before we move to Q&A, what's the outlook for the business? Well, we're operating in a new normal now, both in working patterns and in also areas such as operating with far less paper, both of which I think we'll see long-lasting positives. We're going to see low interest rates persisting in the medium to long term. Every evidence suggests that our market will continue to grow, both in the advised and the D2C space. Security and trust are increasingly important. There are lots of offerings out there. I think having a brand that is well known, caused in no small part by the IPO, we're starting to see the real benefits of that. I think as a business, when we look at our propositions, I think in the early years, I think it was all about broad functionality. And I think we're now seeing a demand from both advisors and our D2C customers that they really want simpler propositions, both in the form of what we offer and in the way we price, and that's something we've very much taken on board and is uppermost in our thinking. But I would say at its highest level, the long term for AJ Bell and the platform market generally is very positive.